Hi everyone, this is Shaurya and you're watching Money 9 Jhatpat. Recently, RBI cancelled the license of 5 NBFCs for violating the RBI guidelines on digital lending operations through third-party apps. It was reported that the companies also harassed customers for recovering the loan dues. These 5 NBFCs are UMB Securities Limited, Ansari Finvest Limited, Chadda Finance Limited, Alexi Traxon Private Limited and Jhuria Financial Services Private Limited. Now, let us see how these NBFCs have become such an integral part of Indian financing system. Well, let's go a bit back. After the economic boom during 2000s, there was global financial crisis in 2008. However, it was believed that India won't be severely impacted by this. Hence, various companies, specifically in the capital-intensive sector, hoped that India would continue to grow rapidly. That's why they even start expanding. Even banks had the same view, so they easily lent for such expansions. However, their expectations did not materialize and Indian economy took a hit. Due to this, all the businesses of companies in capital-intensive sector suffered and they were unable to pay back the loans. That increased the NBFCs in the bank and it also spoiled the liability side of the company's balance sheet. It was called the twin balance sheet problem, where companies were not in a position to take new loans and banks were not in a position to give loan. That impacted the whole financial system and lending system of the country. That's when NBFCs came to significance. Since banks were not in the position to lend, NBFCs started playing the main role. NBFCs provided loans to MSMEs, unorganized sector, home loan, car loan to consumers. Now, these companies were not allowed to accept deposits, so they used to borrow money from financial institutions like banks and mutual funds. However, they borrowed for short term and they lent for long term. This always had a potential to create liquidity problem, and that's what happened when ILFS defaulted on loan payments. This shook the confidence of banks and mutual funds in NBFCs and they hesitated in lending to them. That created liquidity crunch in the country and some tough time for the economy. However, gradually corporates cleaned their balance sheet and banks also reduced their NPAs. Government actions like insolvency and bankruptcy code also helped. It seemed that things would improve, but then came COVID and it changed everything upside down. Liquidity in the system again became a concern. Although government was quite proactive and they came up with various measures like credit guarantees for MSMEs, RBI reducing interest rates and so on. However, banks were still hesitant in lending. It was because their recent past was turbulent and they also feared that in case there was a default, there can be a strict regulatory action against them. Now, someone had to fill this vacuum, so NBFCs came in new digital form. Some of these companies were looking to entice the customers. They lured them by giving quick loans with a minimum requirement. Now, everything comes with a caveat. So, these companies did provide quick loans, but they used to charge very high interest rate. Also, they harass customers to recover money like hacking their mobile, calling their closed ones and so on. So, we can see that NBFCs have become an integral part of Indian economic system. However, as we have pointed out, there are two issues. One being the business model of borrowing short term and lending for long term, and second being unethical practices of some NBFCs. In lieu of all this, RBI recognized the role of NBFCs in credit sector. However, in its recent annual report, it has said that higher risk appetite of NBFCs contributed to their size and complexity. Some of the entities have become systematically significant and that pose a threat to financial stability. So, RBI is looking to tighten its rein over NBFCs. On 22nd October 2021, revised regulatory framework for NBFC was put in place. The new framework set out layered structure for NBFC depending on size, activity and perceived riskiness. And this new framework will be applicable from 1st October 2022. Hope you like this content. For more such content, follow our channel on YouTube, Facebook, Instagram and Twitter.